So in today's class, let me begin the discussion with something as a very simple ratio over here, that is titled as accounts receivable turnover ratio. Now, very simple ratio, but a very important ratio. So I want you people to not just mug up what is accounts receivable turnover ratio, rather than that try to understand logically. Okay. So if I ask you to find average balance of debtors, let us take an example for that purpose. Assume that our company has total annual credit sales of 48 lakhs. Okay. Our company has total annual credit sales of 48 lakhs in the entire year. Okay. So when I say annual sales and annual total credit sales, it is meant that 48 lakhs of sales we are achieving throughout the year. Unless stated otherwise, just assume that sales are happening evenly throughout the year, correct? So a year is comprising of 12 months. So can you please pick your calculator, divide 48 lakhs by 12 months, you would obviously get rupees 4 lakhs for each month. Generally for such calculations, I don't need my calculator, correct? Can you see I am barehanded, no calculators required. But you are not like me, you may require calculators even for dividing 48 lakhs by 12. Now, 48 lakhs divided by 12 months, that gives you rupees 4 lakhs as monthly credit sale. Now, let us assume that I am having credit period of 1 month. I am having credit period of 1 month. Your annual total credit sale is 48 lakhs, correct? If your annual total credit sale is 48 lakhs and I am offering a credit period of 1 month, the question is, within 1 year, how many cycles will be there with respect to making sales and collection? The answer is 12 cycles. Now, how do we get to know 12 cycles? Simply, your credit period is 1 month and there are 12 months in the year. So directly you can find out that there will be 12 cycles. There will be an alternate way of determining the same. How you can do that? So first, as I told you, you work out the average balance of debtors. Average balance of debtors will be 4 lakhs. How did we arrive at 4 lakhs of average debtors balance? 48 lakhs divided by 12 months, or 48 lakhs into 1 by 12, that will give you 4 lakhs as your average balance of debtors. So can you understand one thing? At a time your debtors balance is 4 lakhs and throughout the year your overall sales is 48 lakhs. So your overall sales is 12 times of your debtors balance. That is what we call as accounts receivable turnover ratio. In other words, how many times in the year there will be rotation of this credit sale and collection, credit sale and collection, credit sale and collection. That kind of cycle will go on for 12 times in 12 months. Let us now alter the example. What will happen if I provide credit period of 2 months? So let us again pick your calculator. If credit period is 2 months, annual total credit sale still remaining 48 lakhs, 48 lakhs into 2 by 12 will give you average balance of debtors. So I told you I don't need calculators, you may need it. So what is the amount you are getting on your calculator? It will be 8 lakhs as average balance of debtors. Now use your simple common sense and tell me, how many cycles do you think will arise in the year? How many cycles? Now there will be obviously 6 cycles. One direct way of arriving at 6 cycles is what? One direct way of arriving at 6 cycles is, overall period of 1 year is comprising of 12 months and each cycle duration is 2 months. So how many cycles will be there? 12 months divided by 2 months, and that will give you 6 cycles in the year. However, the formal way of computing this accounts receivable turnover ratio would be, you first find the average balance of debtors, that is 8 lakhs, and then what you do is you divide the total annual credit sale of 48 lakhs by 8 lakhs and you will get 6 cycles during the year. Those 6 cycles represents accounts receivable turnover ratio, and when we compute this ratio by your term, you will say 48 lakhs divided by 8 lakhs, that will be 6 times. You will always write 6 times. When it is 12 times, you will write 12 times. That means this has to be expressed in number of times. Now, what does this number of times represent? It represents the number of cycles that have happened during the year. So, can you tell me what will be two different ways of arriving at accounts receivable turnover ratio? One could be simply total number of months in the year divided by the credit period for each cycle. So, total number of months in the year 12 months, credit period given to your customers, it is 2 months. So, 12 months divided by 2 months will give you 6 cycles. What is the alternate way of determining this? You first find out the average balance of debtors. Average balance of debtors, how will you find? Total annual credit sales multiplied by 2 by 12. So, 48 lakhs into 2 by 12 will give you 8 lakhs as your average balance of debtors. Then what you do is, you take the ratio computation as total annual credit sales divided by the average balance of debtors, and that would give you 6 times as your accounts receivable turnover ratio. I repeat, you will take total annual credit sales of 48 lakhs and divide it by the average balance of debtors. And when I say debtors over here, debtors plus bills receivable, of course, because don't forget, when we say average balance of receivables, it is debtors as well as receivables both clubbed. That is trade receivables and bills receivables taken together. Trade receivables could be just another term used in accounting and finance for indicating debtors. So, whenever you find debtors and bills receivable, for the purpose of this ratio, you are going to definitely club each of these components. Now, when I take you ahead with this ratio understanding, I'll be giving you some important notes, and along with those notes, you will also learn the shortcut ways of making calculations. So, what if the credit period is in number of days? So, what you can do is, you can pick your calculator. Suppose I say credit period is 45 days and the question is emphasizing you to consider 1 year as if it is comprising of 360 days. So, use your simple common sense. 360 days is what the total number of days in the year, that is the question asking you to consider, and one cycle will be of 45 days. So, simply if I divide 360 by 45, I get 8 cycles during the year. I don't need the calculator, you generally need it, right? So, 8 cycles during the year. Now, what could be an alternative way of determining these 8 cycles? Let us now take another example, that your annual total credit sales is 36 lakhs. Annual total credit sales is 36 lakhs. So, if you divide that annual total credit sales by 360 days, 36 lakhs divided by 360 days, I get daily credit sales as 10,000. Daily credit sales as 10,000. Now, what is my average debtors balance? I can easily find out. What is the credit period offered to the customers? 45 days. 45 days multiplied to 45 days multiplied to 10,000. What was 10,000? 10,000 was daily credit sales, because here I am assuming that sales are occurring evenly throughout the year. So, 360 days in the year, each day same level of sale is happening. So, what I am doing, I am dividing the same by 360 days and multiplying by 45 days to get the average balance of debtors as 4,50,000. Now, please understand, once again this example, annual total credit sale is 36 lakhs. we are supposed to consider 360 days in the year, and the credit period offered by the company is 45 days. So how will you compute the average balance of debtors? You first take annual total credit sales of 36 lakhs into 45 by 360. That will give you 4,50,000 as your average debtors balance or average balance of your receivables. That is 4,50,000 once obtained. Now I am asking you to compute your accounts receivable turnover ratio. So two different ways of doing it. One is straight way of computing that. What is the straightest way of computing that? In a year there are 360 days. In this particular example we have considered 360 days, and one cycle of credit sale and collection, one cycle, its duration is 45 days. So you simply divide 360 days by 45 days. You will find that in a year there will be 8 cycles. Alternatively, formally, when you compute accounts receivable turnover ratio, in the numerator you will take the total annual credit sales, that will be 36 lakhs in our example, and in the denominator you take the average balance of debtors and bills receivable combined. So in our case, average balance of receivables, both debtors and bills receivable taken together, that average balance is 4,50,000. So by calculation, if you see 36 lakhs divided by 4,50,000 will give you 8 cycles. Now, why so much of discussion on this particular ratio? It is because sometimes in the question, a question of analyzing credit policy, the question will not inform you the number of days or number of months of credit period. Instead, they will inform you what? Accounts receivable turnover ratio. So if they tell you that there are 360 days in a year and accounts receivable turnover ratio is 8 times, then by default you will have to first work out the credit period what you are offering to your customer. So that time what you will do is you will take your annual total credit sales of 36 lakhs divided by average balance of debtors plus bills receivable taken together, that will be 36 lakhs divided by 4,50,000 to get 8 cycles. Or if I tell you that accounts receivable turnover ratio is 8 times, what you will do is simply take 360 days in the year divided by 8 times, and that will give you the credit period that you are offering to your customers, that will be 45 days. So there may be lots of quicker ways of making calculations. So let us do one thing. With this understanding developed, let us first write some important notes about this whole concept, that is accounts receivable turnover ratio, connecting all calculations, and then I'll give you first of all small questions. And keep in mind one thing, we are learning this ratio typically to have a particular situation dealt with. And what is that situation? Sometimes in a credit policy analysis question, the question may not give you any information about the credit period, but instead they will give you information about accounts receivable turnover ratio. You should be having a comfortable way of converting accounts receivable turnover ratio information into credit period information. So let us begin with some notes writing part. Over here, something very important. So please write in your notes under the heading accounts receivable turnover ratio. So once you have written that heading, under that heading you please write, this is the ratio of sales with average balance of debtors and bills receivables. Accounts receivable turnover ratio, how it is expressed? It is expressed as total credit sales divided by average debtors plus average bills receivables. Let us move ahead and continue writing further. For example, total annual sales, that is all credit sales, given as 36 lakhs. Credit period allowed to debtors is 2 months. Determine accounts receivable turnover ratio. So how can you do this? Average debtors balance will be first of all 36 lakhs into 2 by 12, and that comes to rupees 6 lakhs. And accounts receivable turnover ratio will be total credit sales by average balance of debtors plus bills receivable, that will be 36 lakhs divided by 6 lakhs, that will be 6 by 1, or you can also write 6 is to 1, and in the most formal way you can mention that as 6 times. The best way to express the accounts receivable turnover ratio will be this format, where you write this as 6 times. And one thing that I have explained you as a shortcut, what is that? If I simply give you credit period allowed to debtors directly, and I ask you to work out the accounts receivable turnover ratio, look at the credit period, it is given as 2 months. And now what you do is convert this information of credit period into accounts receivable turnover ratio. So simply what you will do is 12 months in the year divided by 2 months will give you 6 times. Alternatively, if the question has given you accounts receivable turnover ratio of 6 times and asking you to determine the credit period, what you will do is in the numerator you take 12 months available in the year divided by 6 times to get your credit period for each cycle as 2 months. Let us move ahead and write further. If the credit period in above example was 3 months, what will be accounts receivable turnover ratio? So now you first work out your average debtors balance. That will be 36 lakhs into 3 by 12, that comes to 9 lakhs. Then accounts receivable turnover ratio will be total credit sales divided by average debtors, that will be 36 lakhs by 9 lakhs, and that will be 4 by 1 or 4:1 or 4 times. But try to recollect what shortcut I have explained you. If the credit period is 3 months, out of 12 months, if one cycle is having duration of 3 months, how many cycles there will be in the year? That will be simply 12 divided by 3, and that will give you 4 times. Instead of that, suppose the question is giving you information of accounts receivable turnover ratio as 4 times and you need to find out the credit period. Simply what you will do is the entire year of 12 months will be divided by 4 times, so that to explain and represent the each cycle having a duration of 3 months, that is what we call as credit period allowed to the customers. Let us move ahead and write something further. In the above example, if accounts receivable turnover ratio ARTR is 5 times, what will be the credit period? We would say let the credit period be X months. So average debtors balance will be 36 lakhs into X by 12, and that will give you 3 lakhs X. ARTR, that is accounts receivable turnover ratio, will be total credit sales divided by average debtors. So because accounts receivable turnover ratio is given as 5 times, we would write that as 5 by 1 or simply 5 equals to 36 lakhs divided by 3 lakhs X. If you find the value of X, you get 12 by 5, and what you get finally is 2.4. So that 2.4 will be in terms of number of months. Now one thing before you write, if accounts receivable turnover ratio is 5 times, haven't I told you one thing, that you can directly divide 12 months in the year by accounts receivable turnover ratio of 5 times, and that will eventually give you 2.4 months as credit period in terms of months. If you want credit period in number of days, in the numerator instead of taking 12 months, you would take 365 days or 360 days depending upon the question's information. So in the numerator you will be taking total number of days in the year divided by the accounts receivable turnover ratio, and it will give you credit period in number of days. So understand one thing very well, whenever you are trying to compute the credit period from this information accounts receivable turnover ratio, simply what you do is in the denominator you take that accounts receivable turnover ratio. So here we will take 5 times. In the numerator, what you need to do is write up the total available days or months or weeks in the year. Let us move ahead and continue writing further. Determining credit period through accounts receivable turnover ratio. Now this could be simply taken as 365 days divided by ARTR, or 12 months divided by ARTR, or 52 weeks divided by ARTR. The short form ARTR stands for Accounts Receivable Turnover Ratio. So ARTR is 365 days by credit period in days. ARTR is 12 months divided by credit period in months, and ARTR is also 52 weeks divided by credit period in weeks. So this could be shortest way of converting credit period into ARTR and vice versa, that is converting ARTR into credit period. And your credit period calculation can be in number of days, number of months, number of weeks, anything depending upon the requirement in the question.